Good afternoon from Eagle Financial, Friday afternoon. Looking forward to the weekend. Last week we talked about all the troubles, problems, devastation, and disaster in the Bahamas. We let you know about our friends at Living Vine International Ministries, Brad and Susan McClendon, and they've set up a GoFundMe to help the Bahamian people. Brad is actually down there on the ground right now, and I'm sure they could still use financial help and so forth. They have a lot of devastation, a lot of the need for cleaning things up and so forth before they have a very laborious rebuilding process down there. So keep those people in your prayers. My colleague Bill is out of town with a client this weekend. Let's talk about what the markets did this week, what was noteworthy. After we had 4 weeks in a row of market declines, we've now had about 3 weeks in a row. We've had 3 weeks in a row of market gains, and we've had the Dow Jones going up 8 sessions in a row, including today. The S&P 500 was down fractionally today, about 0.1%, but still the S&P was up about 1% on the week, and that brings the total return of the S&P 500, 500 blue chip stocks in the United States that make up that index to about 21.7% on a total return basis year to date. And when I say on a total return basis, that means with reinvested dividends. So what else was noteworthy in the last about 7 or 8 sessions is after we had the 30-year bond yield, never before in history had it breached the 2% level. You know, if you go all the way back to, I think, March of 1980 was the peak made in interest rates. We had the long bond trade up to about 14.5%, and the yield curve did indeed invert with, money markets in the 16% area. So interest rate moves are secular, long-term secular, patterns or trends, and we've been in a long-term or secular decline in interest rate yields since 1980. And so we got down to 1.9 and change on the 30-year, which is still very appealing when you look at there's about $17 trillion worth of Japanese and European bond market securities that trade at negative yields right now. Well, in the last 7 or 8 sessions, we've had the long bond yield climb from 1.9 and change to close today at 2.346%. So the Federal Reserve is slated to ease about 0.25 percentage point next week when the Federal Open Market Committee meets. Yet we've had interest rates or bond yields moving up significantly in the last 7 or 8 sessions. So the short-term bond market is influenced by the actions of our central bank, our Federal Reserve, but the longer-term yields, I'd say 5 years and out, are more influenced by inflationary expectations. And what the bond market is discounting in our view right now is, in spite of all the problems, talk that we're hearing about China trade and so forth, and the dampening effect that's putting on our economy, the bond market is telling us maybe that things are better than expected, or that we're going to have more inflation in the future. But another big news story that made today's Wall Street Journal was the ECB, the European Central Bank, cut their key rate yesterday and revived their QE bond program. So the European and Japanese economies are not quite as robust as the U.S. economy, and they may struggle a little bit more with the China trade issues than us, given the stronger economy that we have here in the United States. So Mario Draghi, the European Central Bank head, has decided yesterday to cut rates and begin a very aggressive open market quantitative easing, bond purchases to keep interest rates, very low. So that brought forth tweets yesterday and today, from our president Trump about us needing to stay competitive, and he wants to see our Federal Reserve ease a whole lot more, I think, than they intend to, next week. And he'd love to see quantitative easing programs in place in the United States to make our interest rates come down, rather than having, a very strong dollar, which can, hurt us economically, in relation to our overseas, competitors. So that's really kind of, the 5-year Treasury note yield last week had gotten down to as low as about 1.3, and it hit 1.75% today. That's a very volatile move in the bond market. Again, the long bond going from 1.9 to 2.34%. If you've been on the fence about, refinancing or anything like that, you don't want to let these yields get away from you. Typically, historically, 30-year mortgage rates trade 130, 140 basis points off of where the long bond is right now, and or the 10-year Treasury note yield. So you don't want to let these yields get away from you and ruin the opportunity to save money from refinancings. We've talked about that previously. So the market's climbing in the last 3 weeks. I think there's a lot of hope that President Trump is going to work out some kind of trade deal with China, especially given that we had Democratic debates last night. We've got an election next year, and one of the most significant things for a president to be reelected with is correlated to the strength of the economy. So the last thing that President Trump wants is to have trade issues with China that would put us into very slow growth or recession. I think that the markets are trying to tell us that they don't believe that's going to happen. So we need to get something done on that front, hopefully. One of the might bring one or two questions here, or points to talk about. Given the rise, the turnaround in interest rates that we've had mid last week and all of this week, a violent move up. The question is have we hit the secular bottom in interest rates? And that's a very important question, especially because if you own long-dated bonds and the bond market sells off sharply, we talked about this. The duration of a 30-year Treasury bond is over 20, meaning that if interest rates at that yield level go up 1%, you lose more than 20% of your principal, unless you hold on to the bond all the way to maturity. So long-dated bonds with yields this low are, in our view, quite speculative in nature. So, we've been trying to find yield and income in sometimes more unconventional ways, but we do like keeping our bond maturities kind of short in this climate. And, as the stock market remains the only game in town, so to speak, we want to get our return, largely from there. But the returns of the intermediate term bond market year to date, have been mid to high single digits. So we've had really robust returns, solid returns there from both stocks and bonds. But if we are at a turning point with us, even seasonally or cyclically speaking, if it's a secular turn, that long-term interest rates or interest rates in general are heading upwards on a long-term basis, that's not very good, for the bond market. So the other thing that we noticed with the stock market in the last about 10 days is we've had a rotation from what we would call growth stocks and into value stocks. So if you go back, if you were to take the S&P 500, those 500 stocks, and you divide it at the 250th stock, you look at the PE ratios of every one of these companies, and then you rank them. The highest price to earnings multiples, those 250 would be termed growth stocks, and the lowest PEs of the bottom 250, we would very simply call those value stocks. Of course, there's some way more sophisticated definitions of that. But if you look at Roger Ibbotson and Associates, SBBI, Stocks, Bonds, Bills, and Inflation, he puts out this maroon-colored book every year that charts all the numbers of the different asset classes historically going back to 1926. Value stocks have far outperformed growth stocks. But for the last several years, we've had, a reversal of that, where growth stocks have done much better. But in the last 10 days, again, we're seeing a resurgence in interest in value stocks. So, and the difference in the PE multiples here is a market difference. Say the average PE of those 250 highest PEs or growth stocks in the market right now, with the PE of the stock market at around 18, growth stocks are trading in the 20 to 25 range, and value stocks with PEs in the 10 range. And some of these classic value stocks like a Delta Airlines or a Ford Motor Company, for example, which are a couple of stocks that we like, trade with single-digit, PE multiples. One of the most important things with this conversation, though, and finding true value, is another ratio that we look at. Is called the PEG ratio, which is the PE ratio, divided by the growth rate. So if you can find a PEG ratio below 1, that means that the stock is selling very inexpensively in terms of its growth rate. Because sometimes high PE stocks might sell at extraordinary levels in relation to their growth and aren't really a good value. And the same can be true with value stocks like that, or they could be termed value traps. They could look like they could be getting cheap, but then again, they could continue to get cheaper and cheaper and cheaper, like a falling knife. So, but we think there are a number of value stocks that look appealing out there right now, and especially companies that sell at very high free cash flow levels. That's one of the most important. Free cash flow yields is one of the most important fundamental measures of in predicting stock market performance, on a long-term basis. We own some ETFs that take advantage of that in our client portfolio. So just kind of wanted to, again, my colleague Bill is out, and I wanted to give a market recap and talk about some of the things that we're thinking about. And one last thing to discuss is that made, news today, that's something to keep watching, is our deficit. And our year-to-date deficit reached has reached $1 trillion. And, I think to put that into context, back in the year 2001 was the last time that we ran budget surpluses in the United States. And when Obama first took office, we had a budget deficit, I think it was $458 billion. But he inherited, the subprime crisis. And the very next year in 2009, we had a U.S. budget deficit of over 1.4 trillion. But it is very unusual. And then, as we've been in an economic expansion since then, since 2009, one of the longest recoveries in the history of the United States. Typically, they're about half that length. Historically, the business cycle goes about 5 years before we enter into recession. But we had gotten back down to, $400 or $500 billion deficits, and now they've been climbing again. But what's most unusual about this is why we have a healthy economy. So, our debt to GDP has climbed from when Obama took office about 62% debt to GDP, and we're now well north of 110, 115% debt to GDP. So we've had almost a doubling of that, and there's a crowding out effect that occurs with that chokes out, economic growth. So this is something that could be very problematic if we have a secular rise in long-term interest rates, because our government is going to have to pay back that interest and ultimately that debt. So this is something, and another reason why we own and we like natural resources, because the Fed is easing next week, and these are weak dollar policies. And ultimately, we think that's going to bring about inflation. And we've discussed this previously. Real currencies, things that are real, like gold and silver. West Texas Intermediate oil closed today just under $55. That's something that we're watching. Natural gas prices have climbed back over $2.50 from the lows of about $2.11. But we do like natural resources now, and but anyway, thank you for watching. Bill will be back with us next Friday. If you have any questions that you would like entertained, we would love to hear from you. So happy Friday to you at the end of this work week, and we'll see you next week.